Hello students, this is Professor Vincent Osaya. Welcome to my class. This is the presentation of part 4 of chapter 3. As you know, chapter 3 zero in on 3 issues: audit planning, types of audit, test, and materiality. In part 3, this is where we left off. We talked about substantive procedures in details, and we said that there are 2 approaches of doing so. We either use test of details or analytical procedures. Now, here in part 4, we need to wrap up talking about substantive procedures. We are talking about due purpose test. What is a due purpose test? This is a situation whereby, recall, we said that every test is either risk assessment procedure or test of controls or substantive procedures. So those are the 3 types of tests that we have. In other words, all the tests that the auditor perform could be put into one of these 3 categories. So the test of control, so when we talk about due purpose test, we are talking about a situation whereby test of control and substantive test of transactions can be done simultaneously. So what does that mean? Remember, we talk about test of controls. You are performing some audit procedures to test the effectiveness of the design and operation of internal control. During the process of doing that, it is also likely that you can also embark on some substantive tests of transactions as well. Now, what does that mean? Let me give you an example. Recall the example that we illustrated when we talk about test of controls, whereby the company has a control that says that the customer's order needs to agree with the sales invoice and with the shipping documents, right? So that is a control that they have in place, just to make sure that if the customer places an order for XYZ, we are actually shipping XYZ and we're actually billing XYZ. Now, the question is, what do? We might take some samples of those invoices and actually see whether all that information agree. Why are we doing that? Our focus is to test the effectiveness of the design and operation of the control. While we are doing that, it is also possible that it will come to our attention that some of these invoices are off. In other words, mathematically, they are not accurate. But that was not the reason why we are going through the invoices. We are going through the invoices doing the recomputation just to see whether the controls are working or not. But then it comes to our attention that there are a lot of mathematical errors in these invoices. So in our mind, we know that if that situation is prevalent or it happens a lot, that will also affect the accuracy of the sales revenue. So in our mind, we are not concerned that it is likely that the sales revenue account might be materially misstated. So as you can see, this is a due purpose test. So while we are doing test of control, we also have some information coming to our attention that a particular account might be misstated. So we call that a due purpose test. Now, let's take a look at the 3rd issue of chapter 3, and that is materiality. So here we said that the United States Supreme Court interpretation of materiality is that a fact is material if there is a substantial likelihood that the fact would have been viewed by the reasonable investor as having significantly altered the total mix of information made available. Now, like we indicated earlier, we said materiality is not an absolute thing. You know what? It's not a black and white issue. Now, what does that mean? Meaning that an amount that is material for a corporation in your neighborhood very likely is not material for IBM or Apples. So the determination of materiality requires professional judgment as well. So that is very important. So moving along, let's take a look at the steps in applying materiality on an audit. We have 3 steps here. Step number 1, from the outset, we need to determine the overall materiality. That means overall materiality for the financial statement as a whole. So we need to establish that from the get-go, from the outset. Why? Because we are being asked as auditors by generally accepted auditing standards to plan and perform our audit to obtain reasonable assurance that the financial statements are not materially misstated. So materially misstated, the question is, what is material for this company? What is material for one company might not be material for another company. So we need to establish that from the outset, or determine that from the outset as part of our planning. Then the second step is we need to determine tolerable misstatement. Look at the said here that tolerable misstatement is the allocation of materiality at individual account or class of transactions level. What does that mean? That means by the time we determine the overall materiality for the whole financial statement as a whole, we now need to break that down for individual account or class of transaction level. In other words, for inventory or prepaid asset, what is material? So we use a different term when we are talking about individual account or class of transaction, and we say tolerable misstatement. In other words, how much misstatement is the auditor willing to tolerate for this particular account or for that particular account? And that would be a fraction of the overall materiality that we have initially determined. Then step 3, we now evaluate auditing findings near the end of the audit as to whether as a whole the financial statements are materially misstated or not. Now, let's take a look at step 1 more in details. We determine overall materiality. Here, it is important for you to know, so how do we calculate it? What basis do we use in calculating the overall materiality? Here we said that the quantitative base for the computation of materiality is a percentage of one of these items, okay? So it could be a percentage on the total assets, it could be a percentage of the net asset, it could be a percentage of total revenues. So we need to go ahead and make that calculation in order to determine the overall materiality. Now, that amount, that is the quantitative amount, may be adjusted lower or higher for qualitative factors. What does that mean? By the time you do the math and do the calculation and base it on a particular percentage and say, well, 2% of the total assets is this is the overall materiality, then that amount needs to be adjusted. We say based on qualitative factors. This is not quantitatively now, but just qualitative. For example, take a look at what happened in the past. What is the potential, what is the, look at the example that they have here. Let us take a look at the second bullet, high risk of fraud. So if there is a high risk of fraud, then we might want to go ahead and reduce the materiality. And of course, as you know, as we discussed in previous chapters, when you reduce the level of materiality, that requires you to gather more evidence. So again, the most important thing is the quantitative amount that we calculate as the overall materiality can be adjusted upward or downward based on one of these factors. So moving along, let's take a look at step 2. Now we have to determine the tolerable misstatement. Now we said that the tolerable misstatement, as we indicated earlier, is the amount of planning materiality allocated to an account or class of transactions. Meaning, it is a fraction of the overall materiality. So if the overall materiality is 1,000,000, we can say 50% of that is 500,000, and that 500,000 might be the tolerable misstatement of a particular account or class of transaction. So take a look at the last bullet. The overall materiality serves as a safety net in the final analysis. So step 3 and the final step, we have to evaluate the audit findings. When the audit evidence is gathered, the auditor aggregates different misstatements from different account or classes of transactions and evaluate to see whether overall the financial statement are materially misstated. So let's take a look at the last bullet. If the aggregate misstatement is less than overall materiality, that is, all the different misstatements put together is less than the overall materiality, the auditor can conclude that the financial statements are fairly presented. If not, then the auditor needs to ask the company or the client to make the necessary adjustment. So, materiality, these 3 steps of materiality are going to be better understood by the time we have an opportunity in the class to actually work on a case relative to this issue. So that is the conclusion of chapter 3.